Hello everyone, this is Keertana, Assistant Professor, Department of Commerce. Today I am here to present a lecture series on the subject Financial Management and its topic Capital Structure Importance. So first we can see the meaning of capital structure. Capital structure refers to the combination of debt and equity that a company uses to finance its operations and growth. It represents the proportion of various funding sources including equity capital such as shareholders' investment and retained earnings and debt equity such as loan and bond. Some companies also use hybrid instruments like convertible debentures. An optimal capital structure balances risk and return, aiming to minimize the cost of capital while maximizing shareholder value. The choice of capital structure depends on factors like industry norms, business risk, and financial strategy. So, capital structure refers to the combination of both debt and equity. Okay, so it also helps to finance its operations and growth. It represents the funding sources like equity capital and debt capital. So in equity capital only involves shareholders investment and retained earnings, but in debt capital it involves loan and bond. So few companies use hybrid instruments like convertible debentures. An optimal capital structure balances risk and return, aiming to minimize the cost of capital while maximizing the shareholder value. The choice of capital structure depends on factors like industry norms, business risk, and financial strategy. So we can see the importance of capital structure. So capital structure plays a crucial role in companies' financial stability, profitability, and long-term growth. So the right mix of debt and equity ensures efficient financing and enhances shareholder value. The key importance of capital structure includes: first one is ensure financial stability, minimizes cost of capital, maximizes shareholders value and improves profitability, maintain financial flexibility, enhances business growth and expansion, reduces financial risk, improves market reputation and credit worthiness. So these are the basic and important key importance of capital structure. First one is ensures financial stability. A well-balanced capital structure helps maintain financial stability by ensuring the company has sufficient fund for operations and growth while managing risk effectively. So it minimizes cost of capital. An optimal mix of debt and equity reduces the overall cost of capital, as debt is generally cheaper due to tax benefits on interest payments. So maximizes shareholder value. So by choosing the capital structure, companies can increase earnings per share and enhance shareholders' wealth. So improves profitability. So proper utilization of financial leverage can improve profitability, as companies can use borrowed funds to generate higher returns. So it maintains financial flexibility. A good capital structure allows companies to adapt to changing market conditions and business needs, ensuring financial flexibility. Enhances financial growth and expansion. So with an appropriate capital structure, business can raise fund for expansion, acquisition and new investment without excessive financial burden. So next is reduces financial risk. An optimal balance between debt and equity helps reduce financial risk, avoiding excessive debt that may lead to insolvency or financial distress. Next is improves market reputation and credit worthiness. So a well-structured financial position enhances a company's credit rating, making it easier to secure funding from investors and lenders. So in ensuring financial stability, it also helps to maintain an sufficient fund for operation and growth for a company while managing the risk effectively. So due to the importance of minimizes cost of capital, it also reduces the overall cost of capital, as debt is generally cheaper due to tax benefits on interest payments. So while maximizing the shareholders' value, company can increase their earnings per share, which is EPS, and enhance shareholders' wealth. So while improving our profitability, company can use the borrowed funds to generate higher returns, so that proper utilization of financial leverage will be happen. So while maintaining the financial flexibility, a good capital structure allow company to adapt the changing market conditions and business needs to ensure financial stability. So next is enhances business growth and expansion. So with an appropriate capital structure, the business should raise the fund for expansion, acquisitions, and new investments without excessive financial burden. So for that, they have to enhance their business and funding resources. Next, to reduce the financial risk, a company can help to reduce the financial risk by avoiding excessive debt that may lead to insolvency or financial distress. So improves market reputation and credit worthiness. So a well structured financial position enhances a company's credit rating, making it easier to secure funding from investors and lenders. So actually in previous video we have seen the capital structure definition. So in this we'll summarize it. Capital structure, it is a combination of debt and equity also that uses a company to finance its operation and growth. It represents various funding resources including equity capital and debt capital. So in equity capital, shareholder investment and retained earnings will be included, and in debt capital, loan and bond will be included. Few companies is also use hybrid instruments like convertible debentures. So the choice of capital structure depends on factors like industry norm, business risk, and financial strategy. So hope the video was useful. Thank you.